How you doing? Good morning. Good morning. All right, running a little late this morning. Gonna have to skip the awesome intro song, or just gonna go through it. Or intro. Okay. Rational. Getting ready to go in 1 minute. Ready to go in 1 minute. Looks like VIX is in complete decay below June triple B. Running down. We're moving up this direction. We are passing through two different yellow lines. So I'm expecting us today. Nice little run up. We get a pull along up to the upper area. That'd be kind of nice to see. We have the DD's been just hella positive. Really nice and clean for the last, ever. It's only been less than, not negative, less than half for like maybe 3 times this year. I've not really seen DD show any signs of weakness. Monthly map showing signs of strength. Life is amazing. All systems are a go. I love that, Jace. I'm a Bryce. They're saying that. Sounds like we're launching a spaceship. God, that was loud. Okay. I think you'd think of swim. I'm going to miss my eardrums. All right, let's get ready to go. One more. All right. Get this going. Love that song. Let's just go here. All right, skipping on in. Let's go. We are gapping up. Gap up. It's going to watch resilience right out the door. Resiliences are nice and positive. Looking clean. Looks like we're probably going to complete that run up to hit that upper DD band. So like I said, we need some data points to kind of come and see. Upper DD band on the S&P is only about 5 points away. So it's basically going to run up to there, and that might complete the move. I think today closes nice, long, and strong. Not really nervous or scared about any of this. Man, she's running today. I got a DD band's right about to be tapped. It could be ending the day right out the door. Okay, let's make sure we interact with the opening price today. We're going to see what we got. Just as soon as we tap right here, SPY. Okay, look. Bull long up, 423.5 support. I wish only we can get these calculations slightly faster. All right, we have Nasdaq and Russell. Still got some room to move. There could be a small trade opportunity in here. QQQ support, half gap go up as long as DDs and resilience is sounding pretty good. IWM. So market's good. Looking for an entry point here to go to long side. I'm spying right out the open if we can. I'm not going to push long on this just yet. IWM about to touch upper DD band as well. We're looking good. DD numbers coming in 94. Oh, nice and bullish. Can't beat this at all. It's looking clean. What's up, y'all? Good morning. Smash that like button while you can. Ooh, gotta love these clean ass days. All right, what's up? Yeah, let's go over the monthly map on SPY. So it calculates through here. We're going to show you what the bull market looks like over the course of the month here. Let's run SPY. Let's run the. So same as before, right? The months are not really changing much. SPY's inflection point seems to come up right about the end of July, as we've been showing lately. Okay, Russell running up and hitting its upper DD band, flipping around the other side. It's going to be like the pullback area. I'm going to watch this very closely. I'd like to see this market try to fade today. I hate when you run up to DD band this close to the start of the day. So I'm going to let this relax a little bit. 42.55 is the new low of the day. We got type 2 resilience going here. So that opening price is going to be any support. So if the market spends an hour or two pulling back, I'm going to wait for the end of the day to get along there. This is going to close on a solid green candle today. I love this. And Russell's probably where the opportunity is, because Russell has been the most depleted of the two, and it's not really, it's now hit its upper DD band. So it's still with a little bit more to move, I would say, if I were to guess. My bad. Sorry, I needed the mic. Let me find that. Let me look for upside yellow lines really quick before I show you the monthly map. Smash that like button while you're at it. I love y'all so much. I need to find a potential upside target today. We're gonna look at this really, really quickly. I know there's one over here. Everything's probably right there. This is an estimate because I didn't do it. I was on vacation, but let's kind of make it. We have to make sure upside target today, and I'll show you monthly maps in just a second. There she is. I don't know exactly where it would be, but I'm going to assume this is where that volatility shrinks up. That looks about right. All right. And that's probably it. All right. Yeah, that's it. Okay. Make sure I get that. Yeah, that red line's been tapped. Okay. Or is that the one I deleted? I think I might have had that one deleted. Let me double check. Oh yeah, that is the one that got deleted. I remember having that one. Okay. Let's go ahead and just crudely find it. There's got to be some kind of upside limit today. What are we doing over here somewhere? Okay, that'll be good. Probably, I'm going to just guess crudely. That looks about right. I don't know why I don't have it here. I'm drawing on one of these other charts. Okay, that's cool. Let's just make sure I have a clue. Okay, so that's really far away. So we really don't have much. Let's look for gap fills on the SPY then. Double check. We got to find, since anytime you're out of balance of DD bands, you need to find illiquidity pivots or gap fills on SPY. Double checking, leading the market today. Oh God, I hate that drawing. Let me go ahead and just get another chart. Actually, I have marked the market scooter. All right, no red lines today. Okay, let me go back to SPY. So it looks like we've got this 427 level to play with. Okay, I'll do a monthly map for one moment, and then I'll come back to it. Just kind of looking for today's setup here. Why? Yeah. Okay, so it looks like the S&P does have some upside targets still to fulfill 427. So we've got quite a bit of a run today. There is some upside here. It doesn't look like we're gonna get any bounce back to jump in on this, but hopefully we will see with these. Resilience is just nice and strong. I mean, this market's gonna hang. This is gonna continue to rally. I have no fear of any downside here today. I think market's gonna look nice and great. All right, monthly map ready. We're gonna predict the future. Let's go. Time to predict the future. Try to see what's going on. You guys ready for this? You ready for me to pull out the crystal ball? Actually, not really the crystal ball. This is more like everybody's left their window shades open. You just kind of peek in, see everybody's positioned. Easy, easy. Okay. Here we go. Bull zones going lower for the next week, 2 weeks. So leading up into Fed, we have FOMC inside of here. You can see that volatility leading to FOMC. You have volatility collapsing after FOMC. You can see how the bears are going to be there's a lot of short squeezing going to FOMC. There has been talks that the FOMC have been planning on pausing, right? That's something we predicted last year. We said that the FOMC would taper down to 0 rate hikes and hold at the funds rate where it was through the summer, and then, start ramping up towards the end of the summer. That's what we thought. All signs were pointing to pivoting middle of the summer, which was likely where the FOMC was going to act as well. So you can see that here's how you analyze this. Pretty easy. What you do is you look at the bottom of the bull zones like this. If you were to draw like a line, you can see that it's just generally getting lower. So ideally, there's more bulls at lower prices. More bulls, you can say the bull side is getting stronger. More people are longing this market. The top of the bear zone, which is the gray lines, you can see is getting weaker. So the bears are getting out of their shorts. Two different reasons for this to rally. Genuine longing, shorts covering. So two of those things are happening in the S&P, and that goes all the way through until, middle of June. There's obviously a collapse. You're going to have bears jump back in to try to short some more. Bears jump back in to short some more. So essentially every pop in the rally we're going to have, people are going to start still planning on being short or shorting this market. But overall, you can see that while we do have waves of volatility throughout the summer, right at the end is where you get that pivot. So you can anticipate, if I were to forecast what the S&P is going to look like, is, let me draw a green line here. Again, you can use monthly maps to do this. Looks like there's bull waves, maybe 1, 2, 3 bull waves. So we're going to have a very rapid run up. I'm talking very rapid, like starting now. Like people are like, oh, it's 1 or 2 green days, markets and rally. I'm saying, no, we're going to 4,600 like in 2 or 3 weeks. And people thought we're silly for saying that, but we've been right. We've been right since October. We've been right, 100% right. And then the market's going to get choppy and volatile again. It might have some really nasty red days, right? And then exhaustion right about here. This nice, clean, little bit of turbulence, is about to squeeze. It's about to squeeze like this. It's about to run. Not a marathon, sprint. That's sprint. And then it gets choppy, but still going to be okay. Bull side is getting weaker. Bear side is getting weaker, which means it's likely not to break highs or lows. It's probably likely to get choppier. And then all of a sudden, we likely start trading down for the year. Now, this looks great. We also said this 2 months ago. It looked the same. Rally through the summer. What's up, Waylon? You like that? Hey, it's like, honestly, we made monthly maps on a hunch that would be able to do that. And so way back in the day, let's see if I have my little SPY chart. Y'all want to see something cool? Let me show you something very cool. Let me blow your minds here. Let me show you something really cool. I'm in a really cool. Watch this. I think I remember, because I used to draw manually before we had the function to do it automated in Rocket Skater. I think out here in the past, I still have a picture of that old monthly map somewhere. I do. I do. I used to draw them manually. I have some of them. And let me make sure I clean this bad boy off here. These are all. This is just like my keep track of everything chart. Okay. Let me show you something cool. Watch the Russell today. I want to see the Russell move because the Russell hasn't been moving a lot. You ready for this? So I used to draw monthly maps manually before we had them. Like I would do the single dates and daisy chain them together. Let's go all the way back. Not Russell. Let's make this unlink SPY. Ready? Way back in the day. It's all, I keep my gaps all in one spot. All my red lines in one spot. Back in the day in October. Look at this. You can still see it. You guys see that? Now, I don't have exactly the day I called the bottom on the 17th, but we used to move them around. But you can see right here, look at that bull side strengthening, bear side weakening. Bear side strengthening just a little bit, and then look what ended up happening. So you can see that the first line is where I drew it. So from this particular day, forecasting out, you can see that the bull side is stronger and the bear side immediately gets weaker. So for a little bit, it does rally. But then as the bear side starts to strengthen, it starts to gain momentum. This is forecast from this day. It's forecasting bear waves coming down. See that? Bear side strengthening. Bear side strengthening. Bull side strengthening. Bull side strengthening. So when they're both pinching together, the market just consolidates. Pretty neat, right? So you can see that this stronger bull side is getting stronger faster than the bear side strengthening. You started to see buyers step in when everybody's like, oh, this is just a fluke. This is just a squeeze. It's not going to last. And you can just see that it lasted. So that's the only picture I have from back then. But we were doing this as it was falling, and once we saw that shift where bulls are actually finally stepping in, we knew it was bottomed. That's how it works. And the monthly map called the bottom. Showing everyone's cards. That's it. All right, here we go. That's what I want to see. Nasdaq's falling the fastest. S&P's falling the fastest. We might get a chance for a long entry after all. Keep an eye on DD. So we're going to say that the open price is support today and hedge pressure is support. So we might actually... All right, you guys. Looks like I get my opportunity after all. Get a nice little long here. Let's double check EVXY. Make sure there's no issues there. No hedge breaks. Everything's nice and clean. Everything's good there. I do like what I see. Let's let it fall just a little bit. Let's double check the news today. I do want to grab a long off of this. I do want to pull back. Okay, double check. We had everything here. Today's events, we had the average hourly earnings came down a little bit, which is good. Wages coming down, something we were forecasting. Non-farms did come out with a huge beat, so it's weird that people are getting their jobs back, but that can explain why the jolts are coming down, but it does not reflect what we're seeing in the continual unemployment claims. So it looks like there's a lag in some of this data lining up. Continual unemployment claims would hint that the non-farms should be not as good as you'd expect, but those did come in as a massive beat as well. So could be lag times in reporting agencies. 339 is massive. It's one of the biggest ones we've had since February is the last one we had. So non-farms, basically non-farm payrolls. You see those are a huge beat today. That's people getting their jobs back. And of course the jolts coming down could also explain why jolts are coming down as well. People getting the jobs back. The jobs are no longer open and wanted to be filled. So it could just be that the continual unemployment claims are, there's obviously people filed for their unemployment or qualified for unemployment, and it's not registered that they've got their jobs back this month yet. There could be some kind of delay in that report, but that is actually a good sign in general. Those are wages coming down too, which is weird because you'd expect wages to not come down as fast as they are when people are rushing back to work. So it's a great, interesting setup that we have. And those are definitely great signs for the economy. People are going back to work. So I do like to see the non-farms come up. Just be careful. Today's not a bleed-off day that just kills the market. Really no sign of anything bad. Let's draw out all our pressures here. I'm just going to circle where I do want to enter. So type 2 res states that, let me get my pencil. Okay, let's mark it up. You guys ready to read? In Nasdaq, I'm going to pull up the monthly map on that as well. Let's just read this really quick. Things are looking really good. Fill that gap today. I kind of like it. Let me just go ahead and throw a couple contracts. Oh, oops. It's not a couple. It's too many. Okay. I'm going to long all through here. Definitely a long day as long as the numbers don't switch around. I want to see Russell get that last little imp. Nasdaq is pulling back pretty hard though. All right, let's measure up. We got a bull long up. Let's draw all the things that we have, okay? Let me make sure I get my DD bands also here. Let me draw them somewhere. Where's those green lines at? DD bands. I'll tell you. I lose track of these things. Where did I put them? Okay, it's right here. Right about there. Change that default there. Oh, because I remember I reset my defaults. Okay. So trade setups today. There's DD band here, and there's one like way down there. Just put it down there. All right. So what we're looking at right now is market's irrational to the upside on DD band. Anytime outside DD band, you need to find the next resistance. So clearly, there's a good R&R to fill that gap. Do we fill that gap today? I think by the end of the day, we fill this gap. Let's go ahead and mark it up. Okay, so first and foremost, easiest one to do is res. You have type 1 inside the box. Res is to pivot from here to there and there to there. So less than 0. Actually, let's draw the red one. Red. Okay, so you have resistance from there to from here, pushing to there. Type 2 is outside the box. Res means if res is greater than 0, we are a rational market. Ooh, be careful on the IWM hedge break as well. So let's go ahead and make sure that this is greater than 10. If hedge breaks. Check, check. Okay, so greater than 10. It's green. Then we're going to support here. That's the support. Outside the box. You want that to support. Pure gap and go. Okay. So, and anytime you're outside and you always support and you bump in the next resistance. Anytime you're above DD bands, if there is a break, you have a nice clean run to the next resistance. That's the next one I can find. So things look hella solid today. I like what I see. QQ is weaker than SPY. Just getting a little bit of weakness. We'll do the analysis in a second. With DD being greater than 0.87, today we're going to stay here. That's definitely support. So there's pressure from here. Like day traders, there's a lot of momentum in here. Swing traders, there's a great amount of dips to buy the longer haul. Like bull zone support, be great. Get a crazy red candle today. Okay, maybe. We'll see. Okay, so we have liquidity map. We have resilience. We have DD. There you go. All right, so any trade plan setups, let me go ahead and mark this just in case we fall. Nasdaq's looking a little booty, but we're all right. Anytime you're outside the box, which you are now, res dips. Anytime res dips, we're going to fall back down and they're going to bump into a hedge pressure. Oh, I didn't draw that hedge pressure support as well. But let's put that in there. Same thing. So for the BLU, I'm draw liquidity map over here. This is a BLU. You open the next resistance. There's a V-shaped move on BLU, so I'm going to complete it with that resilience like that. So these are related to the BLU. You can look on the liquidity map. It's exactly what liquidity map shows. If you open at the or support at the open, you trade the next resistance. If you dip below open, you follow the blue and come back up. So there's a nice little hook move from here to here, from here to there. So my plan is to long here, small, grab here, big, and we're going to fill the gap. I like what I see. Now I'm just gonna be doing my my 10K account. So if you add it all up, there's a couple of things I want to do. Let's go ahead and look. So you can see that resilience is the guiding force today. That's really the only one that's gonna create an issue. I definitely want a long here. I want a long again there. Probably bigger position. If I catch a long in here, I definitely want to trade and maintain a big run to there. If we do dip down to there, there is that BLU hook that I'm going to look for. I'm going to dive in, maybe take a scalp. If things are looking worse, I'm going to close it all out. Keep an eye out on these guys here. That's nice and steady. Things are looking good. Okay. So as you see, when I circled those two things earlier, you guys don't see me draw it out like that. I just can see it because you remember my first drawing. I came on the chart with my analysis right here. I just drew that. That's exactly why I did that. So I do all that in my head because I've done this enough to know how to look at it. This is a gap fill, 427 to change. Let's double check to make sure I have that in the right spot. So anytime you're outside of DD bands or exit rules, if you go to our exit strategies in the Rockets Gear Discord, I have 5 rules I use to exit trades. to pick my resistance. You know, not just pick where your risk is or where you want to get out. You always got to know where your reward is as well, right? You have to calculate risk and reward. Let's... Okay, can I have my 1 hour candles, please? Okay. Okay, I don't have time to fuss with that. So anytime, you always have to make sure you keep an eye out on where you are able to fill gaps. And filling gaps is one of the most prominent things that you're going to look for supports and resistances. Oh, here we go. We might have my trade after all. Let's go here and double check. All right, let me load this up. Okay, I'm getting right to my first entry point. I do like it. Let me take my first long here right at the open. It's some really gross red candling, but doesn't look too bad. So the target is for a gap fill. So again, we hopefully want to see this as support. With the resilience being positive, hopefully we get that. But we're going to make sure we have nothing else coming through the news, just in case. We'll check everything today. You need a slow start here. Nope. Financial juice, anything coming out? Fed swaps boost tightening priced in by the July meeting to 22 basis points. That's earlier this morning. Okay. Okay, so looks like we're pulling back to this hedge pressure level after all. This is good. All right, y'all. Sitting here and taking a look at this. All right. My long from DD band. DD band is not an entry point. It's never an entry point calculation. There's very rarely a case to long a DD band of support. But along here and long here. So you want to see that this is support type 2 resilience. That's definitely what you want to see. Here. So type 2 resilience states that if resilience is strong enough, you're going to want to see the open price. Now, again, we gapped up. Is the gap and go going to hold? We'll see. So you want to see this to be your first support. So this is the first entry. DD bands are always exits. Even though they do have pivoting action, I don't usually take a bet off of them. That's one of the rules that I have is DD is an exit and not an entrance. Losing in QRES. Yeah, so be careful. We have an index divergence alert here, as Louis is noting in QRES. So let's take a look at NQ, what it's doing. Let's see how far it is from its gap fill. And there you go. Like in QRES, you have an arbitrage opportunity here. In QRES, well, I guess I already filled the gap. There's no opportunity, but in QRES is getting pretty booty for some reason. Selling off in tech today. S&P still holding the fort. It's very rare that you're going to see the two that the S&P is pulled by the NASDAQ, so we'll see. Be careful on Q's hedge break. This is a good support right here. I'm gonna make sure let me zoom in on the big chart. I mean the small chart. All right, that's good. I'm gonna see some rescue candles there. Let's look for half gap breakdowns because I want to see which stocks are pulling us the hardest. Micron. Actually, distance. Half gap. Okay, this is the entry point right here, if there is one. Okay. That's interesting. Okay, Meta. Meta just being a big part of that. Let me start by volume as well. So ones that are right on the edge, there's nothing big on the edge. It's going to give it some volatility. But the bigger ones that have broken down, if Apple clearly causing a lot of that move. So when Apple moves from the top of the box and bottom of the box, you see that sensitivity. There's Apple. Let's kind of look at NVIDIA. Yeah, NVIDIA as well. Right, you can see that when NVIDIA is plowing through the box right here and then moving out. NVIDIA also adding a little bit to that. The idea that you see NASDAQ plunging faster than the S&P, it does hint that it is heavy tech that's pulling back. Let's look at the XLK on the sector, and you can see XLK as a sector has pulled back. XLC, and then comms here, same thing. Easy to see how that works. Okay, this is the entry point for the long side. Utilities also looking. Utilities is like the only one that looks bad. Let me double check that I need to refresh this. And communication services. That's it. Everything else is strong. Yeah, this is the entry point. There's that nice green candle we got there. I like it. Now again, we're gonna fight pretty hard, but make sure volatility is not coming back. Volatility still decay. 1725 on mixed futures. I'm not scared of this at all. As a matter of fact, I do think we probably close on a strong green candle today. Don't quote me on it, but the short squeeze is real. There's going to be every bear in the world trying to fade this, but monthly maps don't lie. If I get a strong red candle today and it whoops my ass, Monday is going to be the green that I was looking for. And I won't miss it because of vacation this time. Okay, I'm looking right out the sectors, just kind of see where we're weak. We have communication services. Those are weak. Everything's gapped up and trading down quick. So nothing is red right now with the exception of couple communication categories. So I think technology. So others. I'm going to presume that financials and energy are strong today, and they are. Yep, that's strong, and that's very strong. So we got the big runners today. Finance is the darling child of the Friday today, and the tech is well, there's your dip to buy. If you're a tech fan, that's going to be the low for a while. If it's bullish, this is where technology supports. The next 3 weeks. This is the low. It may seem like this is the breakout high and we're going to fade and sell off from here. If it's bullish, this gap fill right here being support is consolidating. If the squeeze continues, that's a low for another run up. Okay. So keep in mind, if this fades off of this, then I'm going to be very confused. So today's drop down right here is the entry point for tech. And I'm sure all people in the world who are trading this thing are waiting for people that want to get in on tech are waiting for dips to buy, and they're going to be hyper aggressive if my theory is correct. So like falling down to low end when the S&P is nice and steady. It's a fake out, and is a fake out. QQQ hitting nice little supports here on hedge pressure. There you go. There's your bull long up right here on QQQ. Easy risk and reward on here. Let's find some gaps to fill. This is a great long entry point for Qs. Let's go to market. Again, no, not investment advice. I'm giving you guys. I'm just rapping on the market. Don't ever take investment advice from a dude on the internet. That's for sure. You don't know me. Brandon's got a QQQ, BLU QQQ long entry. All right. I grabbed on my 10K. I did go long as well. Okay, so let's get our gap fills. There's one right here. There's one right there. Oops. Clone. 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 There's a couple of them, right? Nasdaq has a bunch of gaps. But make sure we are still trading below those things. Oh yeah, we got plenty of room. There we go. There's my hourly candles. Let's go back. How far back do we need to go? Should get them on the money here. Okay. Okay, just double checking. Yep, that's good. All right, what about you guys? That's good, and... oh, no, you need to be right about here. That fill? Oh, that does look like that filled. Hold on, let me double check that one. I'm missing those wicks. How come I didn't see that on the daily chart? Okay, double check. 15 is there. It looks like that one did fill. Okay, let me just... wick was missing on the daily. I'll not see that. Oh, maybe it did. Yeah, it did. Okay. That doesn't count. It's weird how, like, when you stretch these daily candles, you can't really trust the daily candle, right? It looks like there's a gap that hasn't been filled. There's like a little space. But when you zoom in, it shows it. Like, the scaling of these daily candles are certainly suspect. Just the way the data feeds are. Okay. You have to really mark them at the close, for sure. All right, let's go. Do you lose wicks, including gaps? Absolutely not, James P. Wicks, if you don't think of it like wicks, think about it as the price just touches it at any point. To be careful using wicks, because sometimes if, like, on a daily chart, if your daily candles don't utilize overnight trading, for instance, you won't see the price action. I look at the actual price action. I zoom in like I did to see if any of the actual tapping works. So don't think body, don't think wick, just think if you cross it at all with either. Anytime price equals that close price, the gap fills at any point in time. So that's how you think about it. Yo, what's up, Tommy? Yeah, dude, we gotta catch up. Go grab a beer. I'm down, man. Maybe this weekend, something. Yeah, so like anytime, because like a wick is based on how you change that. So if the price is here, you're really looking to see if the time and sales, like the orders that come through, if any of the orders ever equal that price, then it's game over. So if you draw a candle where that happens exactly on the hour, it'll be on the bar. If it happens sometime throughout the hour, there'd be a wick or a bar that passes through it. Any price, anytime any price touches it, wick or not. So like when they talk about like traditional gap trading, this is what I hate about the original, pathway that trading teachers would teach people. Like an original technical analysis it's goofy on its nomenclature. They have like, okay, you have like a candle, pretend like you have a green candle like this, and you have a candle like this, and then a wick, right? And they go, that's a partial gap fill. That's stupid. That gap is filled. Partial or not partial, like these are words people made up that mean nothing. If you gap up and you return to that price, it's just like if a bad news event comes out and the market trades down and comes right back up to where you started. It means that the action of the event, whatever happened, or whatever the Wall Street sentiment was priced in because you were there before and after the event. It means it's a non-event. It doesn't matter. Non-event. Right? We use the same philosophy in gaps. Anytime you trade off of an event and come right back to where you started, Wall Street was correct in forecasting the price of all things of that after that event, because you always price things in before they happen, right? The efficient market hypothesis. So anytime you return to the normal price, it's a non-event. So if you gap up and you return to the price, it's a non-event as well. It's a non-gap. There's no such thing as a partial gap fill unless you subscribe to some trading book from the 90s or something. If it A fill is a fill, and that's how I've always taught gaps. And that's the most important thing, is that if you gap up, there is an event that's called an imbalance. If market makers are able to bring price down to look for buyers at the same place where they gapped up, then they've redistributed the position that they took that created the gap to begin with. That's the way I try to teach it. Peter, nice job. Trading hedge pressure to half gap on the NQ. You got it, baby. Nice little scalpy scalp there. Looking good. Let's analyze what we have. Safe, nice and tidy. So looks like we are able to continue to try to press. We have created an impact red line on the downside, so be careful. Let's go ahead and mark that on the futures chart. This is one thing I want you to always be aware of. Anytime you see moves like this, your brain should always go, what's the red line? What is red lines, you say? Well, thank God I'm here to show you. Red line's a key code word, I guess you say, for something we call illiquidity pivots. You can see them pretty nice with your eyeballs when you just see a bunch of red candles come out of nowhere, or green candles come out of nowhere. And you can see these nice little runs up that don't have any volatility. There you go. There's going to be evidence that one of these things is here. So I grab a fib tool, and I completely gut all the garbage Fibonacci numbers out of the middle, because Fibonacci numbers are stupid and anything outside of mathematics. Don't get me wrong. Fibonacci numbers are the most beautiful numbers in the universe. They control everything from the shapes of galaxies to how flowers arrange their petals around the core. But however, in trading, they're absolutely stupid. They have no place. These are made up garbage. Okay, so I take the tool, I gut it out, I remove all the numbers, and I make it a ruler with a midpoint. That's all I do. Is two lines with a line in the middle, and the one in the middle is bright red. Because. And you can see when you have effects like this, where you trade down, have volatility, and volatility shrinks, you leave a space where you don't touch this right here. The only fib you need is the 1/2. And when you only look at halves, you're really looking at a process in mathematics called fractals, which means you move somewhere, move half, move half, move half, move half, and you converge. In computer science, we call that a binary search algorithm, where if you're looking at something, a list of things, you jump in the middle and you say, is the thing I'm looking for above or below? Like a phone book. You know, looking for a name in a phone book, you don't start at page 1 and start turning. You jump somewhere in the middle. You go, okay, I'm at M. Oh, the name I'm looking for is W. Okay, is it in that half or that half? Okay, now we've consolidated our list of that half. Divide the list in half. Divide your workload in half. Now let's jump in the middle of there. Oh, that's R. Nope, we're in this half. Okay, here. Oh, too far, too little. Boom, we collapse on the W in like 5 turns of pages, not tens of thousands. So when you create those efficient halfway points, you actually converge very rapidly. And markets tend to do the same thing. Get to your final destination the least amount of moves. It's a trick. It happens. And halfway point is not even Fibonacci number. It's just a principle of converging onto a solution fastest way possible. So only number you need on a fib tool is a halfway point. Little space right here implies something called a red line. Call them illiquidity pivots. As you see, it's going to be resistance and support all day today. It is a new baseline for not only return trade today, but also a possible, we call them yellow lines, which are the run targets, another illiquidity pivot. Red line, yellow line. They started calling them red and yellow lines before we had a name for them, because I don't know, like mustard and ketchup. Actually, just because mine were red and yellow. Watch this today. Watch what happens if we get there. This is a high volume pivot. That's a high volume pivot. You will see that action today. Let's see if there's one in the S&P. Now, if there is any breakdown, that's what these red lines are what create these yellow lines. If you want to see how cool yellow lines are, this technique is one of the things that put us on the board like 5-6 years ago when we started showing this stuff. This yellow line target right here, we do the same process, and we have a bot in Discord that gives you a number. It exploits a principal and margin requirements, and this right here is an extension of risk. It has nothing to do with the word extension in traditional analysis, but this is an extension of risk of this contract. And when you get right to here, look at that beautiful pivot. Beautiful pivot. Beautiful. See how beautiful that is? Calculated, I don't know, 3 months prior, 2 months prior. So imagine waiting for your final target on a run up, and then there's your first resistance, right? Like these gimme days, yellow lines are your first resistance to get out. They are ways to forecast all-time highs, all-time lows. You can't argue with how cool these are. You calculate it here. Look at the pivoting action. Look at how much pivot you get off of this line exactly. I mean, it's on the T, and look at that exact pivot here. These things are very strong, very strong. So I have evidence of where the market can possibly go to, at least as a day trade. That's the target I'm aiming for. So keep in mind, you know, obviously, if there is a downside wave, we're going to measure that yellow line to find where it is. Here's the last one, right? And you can see that one we talked about here becomes resistance. We break through it, becomes support, and then there you go. S&P has them too. Make sure we're always monitoring our yellow lines. The S&P blue horseshoe loves yellow lines, loves yellow line. You'll see that? It's such a cool technique. It is a pure exploit of something in futures. Look at this run up that literally closed and touched that as the high. And look at this gap up that used that as support. This is forecast 2 months prior. 2 months prior. You can do, there is a trick, and what it's actually doing, it is a trick. It is exploiting something that the exchange does. And again, like I said, everything we've done, leave it to a team of engineers to crack some code. Or not really crack code, but solve some math in a way. We didn't. Cracking code sounds of the illegal nature. We just reverse engineered something in a legal sense. Figured out how it worked. This is this yellow line off of here. This one is off of there. Why are you detached from where you should be? Buddy, you need to be right there. So I leave these boxes just to show like the origin point of these things. So anytime you're illiquid, yellow lines are your pivots. Illiquid means outside of DD bands. It means irrational market, anything. So how far up do we go to the S&P? Well, we have one way up here. This one got disqualified because we crushed to its origin point. There's 4,400 S&P. They're not, no, none of that stuff, Marco. Zero of that. They're forecast using the margin requirement of the futures contract. Because those things are set based on the expected move in volatility. It's like, let me give an example. Let me detail how this works. Say I'm an exchange, right? And I create a futures product, and I let you guys trade and market make my futures product. Market black magic. It is black magic. Okay. Say that I have a futures product, and I'm a thing called the exchange. Let's make up a name for the exchange. Let's call it Rocket Man Exchange. Okay, I'm our Rocket Exchange, and the Globex computer in my simulation here is called the Rocket Man. All right, and I need to employ banks to market make my contract and say you guys need to long and short this thing so that my exchange my casino doesn't shut down. You guys are the dealers. I need y'all here every day. Okay. And every day I need you to report your positions to me, by the way, as well. That way I know where you're long and where you're short and the risks that you hold by being with Market Maker. Yeah, Market Maker 2 is like, well, I've been mostly accumulating a sell side position, so I'm kind of short. And this guy's like, I'm kind of long. And every day you're reporting, and the exchange makes an assessment. And it's like, okay, the average people are long here and short there, and long here and short there, and short there and long there. I'm going to say projecting forward, that's the expected volatility of the market. If the market makers are taking the illiquid positions of shorting and longing there, then that's the spread. Any spread between buyers and sellers is your liquidity or volatility spread, right? If buyers and sellers are really far apart, it's more volatile. If they're very close together, it's not volatile. As I want to bring traders to the table, more traders means more liquid. Do we understand that? Fewer traders means less liquid. Any liquid market. So the home market is illiquid, or liquid home market, everybody's buying and selling. Illiquid, you're missing one on the side. Everybody wants to buy and nobody can sell. Or nobody wants to sell. So an example is if more traders come in, then the probability is higher they're going to agree on the price because there's more people. So more traders, you may see the expected range tighten up. So market makers are now in a tighter spot. So when markets are tighter, it's more liquid. There's more participants. There's less likely chance of volatility. Therefore, you want to invite more traders to the table. You're going to lower your margin requirements of the thing. If it costs $10,000 to hold the thing, if you lower it to $5,000, then each person with $10,000 can now have 2 of those things instead of 1. They previously had 1 at double the price. You can have 2 at half the price. Therefore, you have twice the trading power as far as bombarding the market with buy and sell orders. Okay, so if you lower the margin requirement, you can bring more traders to the table for multiple reasons. The easiest one is that it's cheaper to trade that thing. So if you want to make it infinitely cheaper to trade that thing, you make the margin requirements $1, and therefore everybody can buy millions of those things. In principle, you want to make the market infinitely liquid. Don't charge any money for that thing. Make it a penny a contract, and boy oh boy, you will have cajillions, that's a real number, of contracts being traded. So as you see, this absurd relationship is to demonstrate the idea of throttling the margin requirement is proportionally equivalent or inversely proportional to throttling the number of traders to the market. Do we all understand that? Big yes in chat. If you have $10,000 and the thing you want to buy costs $10,000, you can only have 1 of those things. So you're 1 trader in a pool. But if you had 10,000 of those things, boy, you can make a market pretty easily because you have a massive amount of it. There's a lot of you, a lot of traders, a lot of trades possible. You now have 10,000 things to trade instead of 1, right? So the margin requirement is the amount of money that you are required to put into the pot to hold that futures contract. And so that number is calculated based on where dealers and large institutional positions are positioned, because they're telling you, as they're on the other side of trades, they're telling you the appetite for volatility, which is, of course, the inverse of liquidity. So margin requirement, if you just follow that entire thing, is actually a number meticulously set, gauging, not only controlling, but a feedback loop and revising itself based on the changes of liquidity in the market. Not only is changing the margin requirement a throttle, here's a throttled stick. You change the margin requirement, you can throttle how many traders come back to the market. But say I lower the margin requirement and there's fewer traders, then I gauge the market makers and they scatter out. Oh, okay, well, now it's more volatile. Let me throttle it this way, or I'm going to change my margin requirement based on the feedback of the change. So it's called a feedback loop, step change. You change the margin requirement to reflect the state of the market, then you monitor the state of the market. If the state of the market starts to change, then you can throttle the margin requirement again to chase. So it goes in a big circle as a feedback loop. So the margin requirement is essentially like a visibility into the expected moves of that contract based on the risk of the market makers holding it. So therefore, we use that number in a certain principle known as the margin buffer limit to calculate how far a contract can move before it creates absurd amount of risk for the market maker on the other side of that move. It's going to create abnormal amounts of hedging. Imagine if you lose all the value of the contract you're holding, and you were all in long on that contract, you have no more money left, you're forced out of the trade, and therefore you can create volatility that the throttling margin requirement was designed to prevent. So they don't basically want to bankrupt their own dealers under the premise that they have 100% loss of move or 99% loss of move, the value of that contract. So you can throttle, or you can assume that throttle is designed as intended, and the margin requirement is a pure reflection of how far something's expected to move before it hits its first resistance. You can imagine that if I was a bank and I can calculate exactly where I lost all my money on a trade, and I'm going to guarantee that at least at that point I'm hedged in the other direction. So you notice I don't go negative in my money in my pocket just to make a market. So something weird happens when you move a certain distance that equals a certain thing related to that exploit I was talking about, is that you will see there is just an intense amount of pressure in the other direction when you hit that yellow line. And it's all based on the margin requirement. Don't think expected move or average true range or any of that kind of stuff. As Marco has asked, are these forecasts using fractals and measured moves? That's weak technical analysis. Everything Rocket Scooter's done has like pulled out the white papers or the patents the CME group has put out and read those things and found legitimate exploits of mechanical things that happen inside that machine. I mean, I graduated cum laude from my school in chemical engineering. I used to work and do research on the diesel engine catalytic converter as part of the team that helped build the pieces of that. And we designed the catalyst that went inside of that. You think Daddy's going to do a little bit more homework than just basic TA. Fixed catalyst better, rhodium. So the catalyst we designed was I love catalyst. Okay, so the catalyst I tested in the lab, we designed a recipe. So I'm going to draw a monolith. So you guys know what monolith catalysts are, right? So it was actually, so to have the problem with diesel, different than traditional catalytic converter in a gas engine, as you typically want to use an oxidation agent to oxidize unburnt fuel and obviously oxidize, so you basically convert unburnt fuel to CO2. But the problem is that oxidation catalysts like platinum, any metal catalyst is a great oxidation catalyst. The problem with diesel is there's a lot of sulfur and nitrogen. So the thing is that when you have carbon, oxidizing it goes to CO2, which is great. You can spit CO2 in the atmosphere. That's no problem. The atmosphere is full of it. Trees love that stuff, by the way. Sulfur and nitrogen, though, as you oxidize those, they become further toxic and poisonous and bad. Like sulfur monoxide, nitrous oxide is not terrible, but sulfur dioxide and nitrogen dioxide obviously are components of acid rain and other things. And so when you oxidize your unburnt fuel, you simultaneously create a lot of poison at the same time. If you reduce everything the other way, then you create a lot more carbon monoxide, which again is poisonous. So you have this battle where you have to simultaneously oxidize and reduce your environment. So you have to have two catalysts in one. So what we did was we had barium oxide and platinum, just like so. And that's how it worked. So what you would do is you would have your carbon and everything would oxidize on the platinum, and then the oxidized state of things, and again, not drawing too much chemistry, but say you have nitrogen, oxygen, you'd have this connected to the oxide layer of the barium oxide, and you would like store all your nitrogens and sulfurs on there. And then you would induce like a reduction agent, which basically was piss, P, urea. So we would pulse in urea to, in a burst, reduce in cycles. So you would have a reduction stage, oxidation stage, reduction stage, oxidation stage. Very, very, very complex catalyst. So it was you had a monolithic wash code of those two components. And my job as the lowly lab bitch, basically I was the lab assistant. I did work for the department head, so the department chair, so the head of the department. It was a limelight job, and I was the lucky recipient of this project as like I say, the lab bitch. I was the undergrad. Hold on, let me. Wait, hold on, what is it for? 1 second. So you guys got some chemical engineers in here. Fixed bed catalysts of rhodium, not rhodium, but it would be very expensive. And rhodium would be overkill. Rhodium is like the mother. So by the way, if you guys realize y'all are getting me turned on. Yes, whew, I'm getting a little flustered. This is kind of sexy talk. Not only did I get a degree in chemical engineering, I specialized in undergrad. I went to graduate classes. I was actually gonna go get a PhD in this stuff in catalysis and reaction engineering and reactor optimization. So reaction engineering was my specialty. So catalysts were my life for the longest time. And my big plant job, I actually ran an oxidation reactor at Dow Chemical, which was a heterogeneous catalytic reactor that made acrylic acid monomer. Boom, boom. Rhodium, as we called the mother of all catalysts, ridiculously expensive and ridiculously overkill for fuel. You wouldn't care to oxidize with that level of power. It'd be hella expensive too. We use platinum, pretty normal. Although platinum's also expensive. Transport phenomenon, John W. Man, I love transport. I was the one that liked the classes that most people hated. I loved reaction engineering, and I loved transport, and I loved fluids. I loved very highly mathematical transport classes. Those are always fun. So if you guys don't know, like, what's transport phenomenon? Transport was the class where we studied heat and mass transfer, and essentially, best way to think about it is like heat engines, or mass transfer would be like diffusion, or fluids would be the other type, which would be airplanes, right? Aerodynamics, the math of that stuff. Hughes being grumpy. I know, being super grumpy. Thanks to explanation on mean revert MR. It sounds like some are constantly looking at GEX and options positioning. The problem with GEX, Mark Rowe, is a GEX, just like everything else. Rocket scooter is what GEX would like to be when it grows up. They use just a very basic heat map of open interest and Greeks and things like that, and that stuff is absolutely not actionable. What we do that's different is our algorithm extracts from the entire options existence, the landscape, only options that it believes are belonging to dealers. And again, we use mathematical extraction of that. We have a way that we know market makers behave, so we filter the majority of the options out of the puzzle. That's how you can get such a clean split of bull and bear zones on any of these stocks. You pick something. Our split of bull and bear zone is what nobody else does. Where is the risk bullish and the risk bearish? That's what makes us different. So GEX is a very weak tool, just like Max Payne is a weak tool, just like anyone else out there that analyzes the market using options and creates some kind of heat map. There's a couple of people out there that do it. You know, nothing personal to them. Their stuff is great. Their stuff is just elementary. We took all of that to the next level. You get noisy outputs in some of these things, like all these little heat maps based on open interest. Your data gets skewed because some out of the money position that's worthless. We've solved all of those problems to make it a little bit different. So Mark Rowe, the idea is that, you know, if you ever like name something like a spot gamma, right? For instance, it's a similar approach to GEX, right? They look at all the options in existence and throw some math on it and give you like a layout of where the risk is. And then they call it things that don't really match what it does. It's really just a heat map to show you where existing options are from the previous day. It doesn't give you actionability. Like, is this bullish or bearish? Like, it doesn't make a claim to that because it can't. By definition, options heat map is completely worthless. While they are great technologies, it doesn't really help a trader out in choosing if that was bearish or bullish. You have no idea. So the problem is that while it is the step in the right direction as far as analysis goes, it's not worthless information. It's worthless to the trader. It's great information if you're a theory crafter and a mathematician. You can read through that noise and create effects out of it. For the average trader, they just want to know bullish or bearish. That's it. So you can't create that type of analysis and hand it to a trader. It's too complex. It's like asking a trader to solve, you know, options pricing using Black-Scholes. Like, nobody's had the patience to do that. You need to tell them, does that bullish or bearish? And the problem that I don't like about the people whose shoulders we kind of built off of is that they'll provide something that looks like this, or GEX looks like that, and you read it and it's like so open to interpretation. Is that bullish or bearish? And it doesn't make a claim. Oh yeah, that's definitely bullish and bearish resistance. It doesn't claim that because it doesn't want to. It doesn't want to take that risk. Because it's left open-ended because you really don't know. You ever see those options heat maps? They literally look like this. Good luck, average trader, right? So the idea is that not every option has meaning, and that's where we came into play with creating what we did. So the idea is our algorithm will find that risk imbalance between bulls and bears. It will find it every time and divide it to bear and bull side. Pick a stock. It will always have the cleanest split that the algorithm can find. That's part of it, the mathematics of having the splits. We call it the auto depth, quote unquote. And that was one of the most sophisticated pieces of mathematical machinery I've ever written in my life. This little thing right here is very sophisticated. It's the algorithm that it sets the parameters for the risk model to decide, are these market maker options or not. If market maker options are designed to be hedges, to be risk to zero on an overall position, that's what we look for. And we automate the whole process. Yeah, at the end of the day, traders want to know, where do I long, where do I short? Traders don't want to see an options heat map and say, okay, so do I go get a PhD today to analyze this, or do I have to have my buddy that's a good mathlete to tell me how this works? Up another 2K today on my trade. Not bad. I think I should keep holding. What do y'all think? Let me see SPY really quick. Remember, I want to trade. I want to trade to fill the gap. So the risk and reward is there. It's pretty good. If we start killing this like trade today, I don't know if I'm gonna like it, but just keep an eyeball on Nasdaq resilience. Somebody asked the question. Funded by UOP. I can't. No, we were. I don't know who funded the project. I think at that time I probably remember. I know we did our work in a facility that was owned by Schlumberger. We had these giant 18-wheelers on humongous dynamometers. Like, they are like 10-foot diameter. So a dyno is like where it's like a giant drum turned on its side and it spins in a circle and you basically drive a truck indoors. It doesn't go anywhere. So you're driving on top of a thing that's rotating against the rotation of the tire. So you're basically driving in place. And so we would sit there when we actually got out of the lab. So I built my reactor in the lab. So myself and the grad student and the postdoc built a reactor in the lab. It's very crude. We use like beakers and tubes and stuff. And the catalyst was manufactured by, let me think, I remember. Our part of the project was to create the recipe of platinum and barium oxide. So like it was a global project that so many teams worked on. Don't think you can credit me for building the converter itself. It was a global project. Everybody around the world, there were dozens of teams working to solve this. What was the perfect catalyst? What was the right temperature? What was the reducing agent? Everybody worked on different pieces. It was a race to beat the Clean Air Act. It's actually kind of a cool part of my life. I actually forget that I did this sometimes. So the Clean Air Act in 2007 was the race. All engines had to be retrofit to have these devices in them. So, you know, I graduated in 2005 from college. So everyone was like part of the race to create the technology in different pieces. So our job was to create the recipe of how much barium oxide versus platinum. Was it 60-40, 55-45? And we would test essentially the conversion of your exhaust output into the components that you wanted to convert them to. So like I spent 2 years throttling that recipe by a few percent back and forth. And we tried a couple other components too. And I'd go in the morning, I'd set up my research. We would measure the absorption rate onto barium oxide. And essentially it was like a little, it was fun. It's such a fun project. I love doing it. So like we had this thing, it was like you had a stick with like a little crucible on it the size of a pencil eraser. You had a control and they literally were like this, okay? And I would scoop my catalyst into one of them and one of them we control. And we would flow the gas across the surface of this. And so you have like this solid powder, and they call it adsorbing, which just means stick to the surface. Gas would like stick to it. And we would measure the weight change. That's the crude way to measure how much gas you absorbed before it reacted. And it was so sensitive, it measured in picograms. Imagine like gas molecules don't weigh anything at all. Picograms. So if you were sitting next to this machine and you sneezed, the data would go, it would spike. It was so sensitive to pressure that we had a sign on the door that said, take your shoes off before you come into the lab. Even walking with your shoes could mess up your data. It was that sensitive. So I walked around that lab for 2 years with my socks on. And every time I sneezed, I had to write down the timestamp of when I sneezed so I can remove it from the data. Because you're measuring a gas molecule sticking to the surface of a solid. That's very, 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 very. It's a scale that would measure very small amount of weight change. That's how sensitive it was. And there were even flow mechanics of how gas flows over the surface that you had to zero out, because just the gas doesn't even flow. Even a laminar flow would still create some kind of oscillatory wave against the crucible. Like it would move such a small amount. You had to zero out that data too. No chips. Fuck no chips. No anything. If you had to talk, you would do a hand sign and you would walk out of the lab. Like every time. So essentially, if you were far enough away from the machine, the sneeze part's the joke. If you sneezed on in the machine, it was sensitive enough that if you were like across the room, you could probably eat your lunch. But if you were like in the lab area, measuring such a small pressure wave would create. So essentially, you just had to know if you made no cell phones rule, things like that, and you just had to know that you fucked up the data for a minute. And how long did it take to absorb a measurable amount of gas on the size of a pencil eraser? It was like 4 to 6 hours. So I'd go in the morning, set up the experiment, turn it on, run the gas, and then go to school. Then after school, I'd go manage Domino's, which was my other job. That actually paid real money. Working for the school was great. Tax-free $10 an hour at the time because you worked for a state university. But working at Domino's, well, that made Daddy's car payments, and also helped me pay for my my gambling losses at the pool hall, because I was not that great at pool, but I still love to play people $5 ball. So, those are the days. Those are my 2 jobs in college. Well, actually 3, because I also taught. So I did scrape my way through school working. All right, that's $3,300. Hitting that double top. I'm going to go ahead and take profit on that, because I do have some meetings today. I'm going to close out my trade. Hold on. We'll have story time. Thank you for tuning in. Here's Papa's 10K account, another 3,300. I think I'm up like 12 or 13K this week. I'm 2/3 of the way there, looking great. I just called it. Now, again, it's going to rally to here. I do like the idea of this double topping. I don't want a couple more hours to do. I should hold a runner, but that was a pretty decent trade. I love it. Engelhard is who made our catalyst. It just popped into my head. Now, I don't know who sponsored the project, but our catalyst that we made was made by Engelhard. I remember. And actually, I was cleaning out my garage a couple months back, and I found my old plastic container that had my lab notebook in it from then. It was actually really fun. But anyways, just tell you guys, like, I'm honestly insulted looking at technical analysis. It insults my intelligence a lot of the time. When I look at this stuff and I say, this is what people sell to other traders on the surface to like predict the stock market shapes of the price and like what it did yesterday and last week. And I just want to vomit in my mouth that people widely accept that. And then they widely accept that, well, there's a high failure rate of traders and never put 1 and 2 together, figured out why that is. The analysis, no offense, is completely junk on the surface. Technical analysis is great if you are great at technical analysis and you are a master at trading. It's, again, just like your options heat map. It requires a master to manually ride and fly that plane. The average person can't come in and stare at a bunch of indicators and immediately pick it up and go, oh, that's what I need to do. It requires such subsurface level analysis that it's impossible. the average person to pick it up and succeed with it. They exhaust their patience before they acquire their mastery, right? Oh, I love that quote. I just made that up. Let me write that down. Great trading, y'all. But right, so when the stuff that we wanted to create here was, you know, the team actually started with a group of engineers, like our little crew before we even made Rocket Scooter, before I even made DC, before I made anything, was a group of friends I met on Reddit. They were all engineers that traded, and we just thought the existing stuff just seemed dumb and insulting to like what we wanted to build. And we're like, there's all these mechanical systems that mathematically like, you know, determine liquidity and measure flow in real time and order flow and react and respond. Nobody at Citadel running these massive order routing machines have charts on their machines, drawing pictures on the charts. That's just dumb. This doesn't exist. Like nobody is using charts on the computational level. 0 people. When I hear people say, well, I developed this algorithm and look how cool it is, and it's drawing on the chart, and some hedge fund wanted to buy it from me for $100 million. They did not. Nobody wants to buy your junk. Ever. Never will somebody buy something that draws pictures on charts from someone that created. It's not an algorithm. First of all, it doesn't make smart decisions. It doesn't do anything. It just draws pictures on chart. Nobody in the center of the market does anything of the sort. Nobody does charting at that level. It's all real-time liquidity analysis, where buyers and sellers are, and it's done as fast as possible. It's all robots designed to intercept order flow, to be the first one in the trade, to auction against other people, to get the right to have the trade. I mean, it's all the sophistication that your colorful neon purple triangles don't know about. Nice job. Yeah, caught. So the idea was like when we got started, we were like, okay, how do we create something that's more sophisticated? Like our appetite is much bigger than just basic TA. Our appetite's to create something that is elegant on the surface, simple to use, and solves a very complex problem. Like, you know, Apple's mentality of the iPhone. It's elegant right out the box. There's not a lot of analysis or interpretation that needs to happen. It just you open the box, turn it on, and then there you go. And it's intuitive from the surface. And our goal has just been, like, as the years go by, to make this more intuitive. And as the years go by, we hope to do so. Like, this is the intuitiveness of liquidity map. You've got 8 possibilities with a 9th mean reversion. And each one of these shows me where pivots can be and match colors with colors. And that's like the sophistication that's under the hood. And so for when we got started, it was just like we were just insulted by the idea that this is what everyone uses. Either A, everyone's stupid and just lucky, or B, this isn't what really everyone uses. This is what everybody thinks everyone uses. And it turns out the latter is the answer. The basic technical analysis is not what everyone uses. Everyone, meaning the majority of trading, is done computationally by computers that don't use anything like that. Those are things sold to retail traders that had merits at times, but require expertise to operate, right? It gives you a little additional insight to the market. It doesn't really give you the answer that you're looking for, and it requires your expertise, and you're a newbie with your first day on the job. You're not going to understand all the complexities of the market, and you're going to apply weak tools that are weak because you're weak, and they don't get strong until you get strong. And so you hit this problem that you have to be an expert out the door to use the tools that you're trying to use when you're a newbie. Doesn't make any sense. So it's like traders get lost, and then they don't make money, and then they lose, they give up, and the failure rate of traders is high. And that's partially the reason the tools are just bad for them. It's an expert level tool for a novice level apprentice, right? They need to train on something more basic. And the more basic stuff is actually really good, like understanding gaps and how gap fills. Like, those things are very repeatable. And we were like, let's find repeatable stuff that's based on something mechanical. If there's an airplane that's designed to turn these many degrees to the right, if it hits a headwind to the left, then that's an equation. You can create a linear transform of that. If there's a differential relationship, you can create an equation. You can create repeatability. So every time you saw that wind coming, you'd know it'd steer the other direction. Could we find things like that? And found many things like that. And that's where Rock Scooter was born, because that's the whole purpose of the name. Like, the scooter was what everyone else was pedaling with their feet, and we put the rocket engine on the back of it, amp it up. But to you, it's still a scooter. You don't care how the rocket engine works. You just get on it and it flies you. And that's kind of the elegance of the name, right? It's to give you a little extra. Like, we're the engineers, and we boosted your scooter a little bit, made it fly. And the point is that, you know, it's an endless quest. Like, we want to be pioneers in the field. We don't something like, hey, here's the answer to the stock market. We figured it out and we're done. It's not possible, right? It's an endless space race, no pun intended, for technology. There's always going to be somebody one-upping somebody, and you always have to constantly develop the next thing as someone develops the next thing. As market making or exchanges become more sophisticated, data becomes more transparent. If a new data feed comes out, we'll know it. Like, part of what we do is we know what's available to us and available to retail. If a brand new data feed comes out and there's a little bit more transparency, CME created a version 2 of this span program they use to set margin requirements. We're on top of that stuff. We're like, ooh, they changed something. Okay, and what can we build off of that? There's a new program out there. Ooh, there's a new protocol. Ooh, there's a new law. There's a new regulation. What can we get out of this? Right? When options expirations became 0 day every day for SPY, we created a rule out of that. Don't trade after 2 p.m. any day possible. When they used to be Monday, Wednesday, Friday, it was don't trade after 2 p.m. Monday, Wednesday, Friday, because the option mechanics don't jive well with a stable market. Like, you tends to be a little random. So when the rules change, we change. And so we always, like, what we commit to is a space race. We're constantly sniffing the airwaves for exchange changes, law changes, regulation changes, reading every lawsuit, every patent, everything comes out. It's like my favorite thing to do when I go to bed. Figure out who the CME group sued this week and what they sued them for. Like, what kind of rules are they breaking? Well, that's how you figure out what the rules are. There's little clever ways you can just figure out how this world works if you're an engineer designed to be an investigative sleuth. So we always want to build and always want to make. Nice job, Karan. Killing it, baby. And that's the goal, is that as sophistication improves, you're not stuck in a newspaper world drawing shapes and patterns on a chart. And that was invented like in the 70s. I don't know. And I don't dog it because of the hatred of it. I dog it because of the way it's sold to traders. It's like, here's how it works. Here's how the market works. Not true. It's a lie. It's how you analyze the market, and it's great at that. Not terrible at it at all. But it requires you to be good. It's kind of like if I handed you an X-ray of someone that had a tumor in their lung, and you weren't a doctor, you wouldn't know what that blurry black and white photo looked like. You hand it to a doctor, he'll say, oh, there's the tumor and there's where it's spreading, and he's got 6 months to live. That's technical analysis. Without going through med school and without understanding and having the experience of staring at millions of those things to know what you're looking at, you're just going to see a bunch of blurry black and white images, and you won't know shit. And that's why I always try to teach traders is that you're promised something, and you're basically that. It's your first time you ever seen an X-ray, and you don't know what you're looking for. But you're expected to use that to make all your decisions around the risk of your life savings with. Good luck. Good luck to you, sir and madam. And it's a great analysis to look at, right? A doctor will look at X-ray and go, shit. How do we tell their family? Like, for the moment you see it, there's not even a hunt for it. You've seen tens of thousands of those things. You're an expert at it. I think the market makers had a part in introducing daily zero TTEs. No, it's completely the exchange. You introduce, example, you have a casino, and you want to make more money as a casino. You put more tables in the casino. You want to make even more money at the casino. You put a table that costs $100, table costs $50, table costs $20, table costs $1 for the same game. You expand your games. You bring in a bigger variety of people. You give people more, the word I'm looking for is, what's the word I'm looking for? You give the ability for people to fine tune by, like, you have more options to do something. You're going to fine tune. Imagine if you had to hedge, but you could only hedge in increments of 5 because that was all is available, but you needed 6. Well, you'd have to buy 2 5s, and you're 10 and you're overkill. But you can buy a 5 and a 1 now, right? And so the more sophistication you give people, or the more granularity, there's the word I'm looking for. It finally came to me. I hate getting old. The more granularity you give traders, the more trading you'll induce, the more precise people can be. The more precise people can be, therefore, the more they'll trade. If you're like, an example, well, I want 5 and I need 6. All right, I want 6, but I can only do 5s. Well, I don't really want to buy 10. I'll just underhedge. I'll buy 5. But aha, there's an option for a 1. Now I can buy a 5 and a 1. You just made me trade because you gave me more granularity. You create more granularity by creating more contracts. You bring more traders to the table because it's all algorithmic. So imagine you can get extremely precise on the amount you hedge. Like precise means like repeatable accuracy or repeatable action. So you create more trading with more tables. And so the exchange simply made more instruments to make more money because you pay an exchange fee for everything you trade. The actual history of going to zero DTs, and we used to only have monthly options, and then they created quarterlies and weeklies. Then they created daily expiring weeklies that expired Monday, Wednesday, Friday, when it used to be only Friday. And now they have Monday, Tuesday, Wednesday, Thursday, Friday. Why? Because they make more money selling you more things. So I don't think market makers may have some input, but it's a very simple decision to make if you were the CEO of a publicly traded company like the CME Group. You would obviously want to create more revenue for your company. You would create more things for people to trade. Imagine it costs you nothing to create an instrument. You just need somebody to market make it. Imagine that you had an ice cream shop and you only sold chocolate. You're going to sell vanilla, then strawberry, then cookies and cream. Then you're going to try to have something for everybody. And the more you make, as long as it doesn't cost you much to make it, the more money you'll make because you're going to keep expanding the amount of people that trade your products because you give them the granularity to trade what they need to trade. That's in micros. And the same thing happened in futures, right? They created, you had your S&P futures contracts. were very expensive, and futures trading wasn't growing fast because everyone was trading stocks and penny stocks. A much lower barrier of entry for traders to trade stocks in the 80s and 90s as retail started picking up. Imagine the mini wasn't even around at a time. They created the mini to bring retail traders to futures, make it easier to trade futures, more granularity. Then they created the micro, and then they created the nano. The Ferex exchange made the nano, which is a subdivision of the micro. So you have that granular risk, as I like how Nico said that. Yeah, that granular risk they created allows more traders to trade it. So imagine now that micros are there and you can pay $50 on your intraday margin on micros. Let me make sure I've closed all my trades out. I always get paranoid. I'm good. Okay. There's that gap fill, making that money. And so the idea is that you bring, how many of you got into trading futures when you can finally trade $500 a contract, as brokers would split the risk with the clearing firm? Now that you have micros, you can trade $50 a contract. Imagine the birth of these trader funding programs off the backbone of that. Look at how many people trade futures now. You bring granularity to the table, you bring more people to the game, and that's it. You go to Vegas and it's all high roller tables. Well, then they can't, even though they like to make $100 ante per person, there's 9 people watching for every one person playing, and then they put dollar tables there, and then everyone's playing. Maybe you made $100 for one person, but then you made $1 off of 9 other people. Now you made $109. It's 9% increase in sales. Massive increase, right? So you think about it like that. And this is the end of the day. This is a great end of the day. Looks like we're gonna hit that gap fill pretty soon, the S&P. Glad y'all killed it. Love what I did. So that's why I always say that, you know, granularity is a big thing. Yeah, PDT roll is outdated. It is, and that was created, I think, as a result of the 29 market crash, where you can lever up, or somewhere after that. Like, actually, no, the margin used to be 10-1, by the way, in equities accounts, in margin accounts. After the 29 crash, that's when they changed it to 4-1, because people got so over levered in the stock market that could create massive. So I think that was the result, somewhere in there. And the PDT rule, obviously, is to make sure traders have enough risk in their account to be able to borrow money to trade with, which is what margin is. And they don't let you do that unless you have enough money there. That's to give, you know, less pressure on the brokers to have the cash available. The brokers will never fight against that, because if you have money available, then you can lose your money before you liquidate your position, because you're going to lose their money, and therefore volatility is less, and therefore everyone's fine. When brokers make commissions and exchanges make commissions, volatility is the enemy of commission, because volatility means less liquid. Less liquid means less traders. Less traders mean less money come up the ladder. So I don't think anybody would fight that PDT rule. I think they would argue that that's the best thing to keep the market stable. And I would never, even though it feels outdated because it prevents retail traders from coming to the table, arguably everyone makes more money because it's there. And you can still trade, just not with the margin account. So the question you should say is, like, if you were a bank, would you loan $40,000 to somebody with 10,000, or would you rather loan 100,000 to somebody with 25? Because that's what you're doing. You're loaning money. So you have to make sure that the people you loan money to have the assets or the ability to come up with the assets to cover the margin call. When you call somebody with a margin call, your hope as a broker is that they deposit more cash. And if somebody doesn't have any account minimum, they could still borrow margin. You can't guarantee that person has the ability to whip up some cash. But if the average human has $25,000 of spare cash sitting around, they probably got 50 and probably got 100, probably got more. And that's why that's probably not going to ever change. Remember, you don't want to say you got a margin call and then they say, shit, close my position. You want to say, hey, you have a margin call, and the rich will goes, well, let me just wire another 100,000 to the account. Because if you do that, then they don't have to close their position and create illiquidity and problems in the market. So in a net sum, that rule essentially makes it a high rollers table. of people that have the ability to float the stock market with money. And so if you got rid of it, obviously it would create more margin calls that people would actually liquidate instead of cough up money. So I don't know why 25,000 was chosen at the time it was. It was probably considered like, like if I were running the show, it's like, that's the amount that I can assure. If you've got that much money to throw into a gambling account, then you've got more money to throw into this gambling account. Right? So it's like, it's enough to ensure that the person you're loaning money to is a whale, so that margin calls don't squeeze everyone out of their positions. I think that's the reason it's there. Now, should it be modified? Should it be lowered? Should they have different levels of margining? Like, could you get 4 times margin at 25 and maybe 2 times margin at 15? Could you change it? Maybe that's needed. You still have to have some kind of scaling risk based on the probability that people will deposit money if they're squeezed. Because you don't want to squeeze to create liquidation, because that's when markets go out of control. When markets go out of control, even Rocket Scooter loses power. Like, you get irrational random markets, this shit's going to turn red. We don't want margin calls causing liquidation. We want margin calls having somebody say, okay, you know what, I'm going to hang on. I'll throw some money in tomorrow. Stock market would never see any action off of that margin call, which we like. Pattern day trading rule, and even if they made it more expensive, would make Rocket Scooter stuff even stronger. You have less probable events going random. You have the coupon for ETF funding. We don't have a coupon for ETF funding. Elite Trader funding. I'm sure other people do. I would ask around. Anytime you sign up for these trader funding programs, they all have these massive deals going on. I think I heard that to the grapevine they're having a special right now. They're all always offering deals. So the best place to ask is to ask anybody that uses it, or anybody that's an affiliate, or who do I know that uses ETF that's an affiliate? If I knew a coupon, I'd give it to you. I don't know anything. Have I considered trading 20 accounts at once with a trade copier? Are you talking about in a trader funding program? Or in my own personal account? There's no reason to trade 20 accounts when you can just trade 1 account. If you're talking about like funding program accounts where you can do that, very, very possible to do that. As a matter of fact, when Rocket Scooter is going to have futures trading in about a month, finally, we're building it every day now. One of the first features that will come out, we're going to try to have the ability for you to connect your trader funding programs through our thing, if you can. Now, it's going to be tricky with the data, but you'll still be able to at least log in and send orders through, even if you don't get the futures data. The whole thing with that. But we're going to work to that, and we would create a trade copier with them for that purpose. Futures is weird. I'm not going to go over the details of how futures data feeds work, but it's different to stock data feeds. Like you buy your data from us, from Rocket Scooter. We pay the exchange to be able to redistribute data to you. We pay a lot, you pay us back. You pay for your data. Futures, you can do that in futures. It's just magnificently expensive. And so nobody does that. Futures is a different construct of how they have their system set up to where it's available for retail traders to get your data. The way you go buy your data from Trade-of-8 for like $10 a month or something like that, or buy your data from NinjaTrader for like $10 a month for your futures data. That's the way the world works in futures, and that's the way it works here. With an active brokerage account, you can get data for like $10 a month. So the problem with trader funding programs are not active brokerage accounts. So normally an example is you have like an elite trader funding or something. You have to pay on top of that to get your top of the book data, right? You have to, you're paying Trade-of-8 or somebody for that data. Yeah. So for like data feeds, we're going to have futures data. If you have an active futures account, you will be able to supply futures data from your broker to Rocket Scooter, and that's how it's going to work. So like example is if I go out there and create pick a FCM, Go out there and create a Phillip account. I could trade my Phillip account through Rocket Scooter. I pay Phillip for the data. Then I'll get futures data. If I don't have that set up, then nothing will come in as far as futures data goes. So futures data is a little different than stock data for sure. But that's how it'll work. You're on Apex in a single account for now. How's it working with you on your Apex? You like it? Somebody says ETF withdrawal rules aren't bad if you can get consistent wins. They don't want big wins. They have to pay out. And that's all of them have that same problem. The middle stage, when you're actually not in a funded account, you're in an account that pays out, but it's still a sim account. They have to pay you from like their own cash flow. So it's like they want to wait because they don't want to continuously have to pay out because it's coming from their pocket. There's no real trading gains. Like ETF's elite account is not even a real trading account, even though it pays you out. It's still a sim account, which means they got to pay you from their own pocket until they fund you. There's a third funded account called like elite funded, I think is what they call it. So most of them have like that stage that they pay you even though it's still sim. That's kind of a weird thing they have, but it means they have to pay you from the money that they make from everyone else. The other Matt has one. Does he have the elite account or the elite funded account? Is he on the third ETF? Is he on the third step or the second step? So ETF basically has 3 steps, right? It's not really evident on the surface on the website that they got 3 steps, but they got 3 steps. Now, step 2 pays out, but step 2 only pays out a certain amount, and then they move you to step 3. In step 2, you got to wait 45 days to get your max payout. Yeah, Tracer Matt. Is it he has ETF or who's he using? I thought Matt used Top Step. When you get to the funded stage and they trust you with the money, trust me, they love that you're making them money and making you money. But until you're at the funded stage, you're part of a system that you get paid from the company's pocket, and they have to make more from the people that don't get paid to pay out the people that do. Yeah, Matt uses Top Step for sure. That's what I thought. Matt does use Top Step. As long as I know him, he has. Look at that. You have a great trading day today. What a great end to the week. Trailing drawdown that calculates from highest open balance in a position goes against you, forces to scalp, and obviously keep size small. That's exactly right, Zach. The best approach in any trader funding program is to get a static drawdown account. I determined that when I was playing around with them, in any of them. A static drawdown is the way to go. It's the highest probable chance that you're going to get a funded account and the easiest one to maintain, because like imagine that you were a 50-50 shot of building off of the starting point. The drawdown, the further your gains go, the farther away you get busted on the account. Like the trailing drawdown, it keeps like a tight leash on you. Imagine like if you use a static drawdown, your first trade is the most important. If you have a 100K account and you fail at 99K, you can lose 1,000. So it's really tight. Your very first trade is the hardest trade because it's the tightest loss. If your first trade is a guaranteed win, so you wait until it's a guaranteed win, and you hit your first trade hard just to build a buffer, then you trade small after that. And so the philosophy there is we mathematically determine that's the quickest way to get to the finish line. Because if you do go bust, a lot of times those static accounts, you can get one right back up and running within 2 or 3 days. Like the ETF requires 5 days of trading. I did 2 back-to-back in 5 days. Hit one, hit another. And then you just wait so that you don't ruin the account. And then as you're waiting, you're building more accounts and building more accounts. Just build up as many of those as you want. And those are sitting on the sidelines. So if your first account goes bust, you got a couple sitting there waiting for you to go. And so you just wait and wait and wait. And your first trade that comes out the door, you hit it pretty hard. You don't go like all in or do anything crazy. When I say hit it hard, it means you're confident in your normal position. So example is if they say 4 contracts, and that's your 4 contract trade. Wait till you hit hedge pressure, bull long up, all signs look great like today. You would hit it right at your first entry and you would have made a pretty decent windfall on your first trade, and then that's it. Now your 100K becomes 102K and your 99K is your off. Now you're 3K away from busting. Now you trade where you only can lose $500 or so a day. So now you can go on. It takes a massive losing streak to bust the account. So now you float that account and you're good. If you bust that 1K on that first trade, then you just wait, and you've got many on the sidelines to wait for a good trade then. Your first trade, it's faster to have your first trade possibly knock you out and build a buffer for the longevity of the account and then reset if you lose than it is to sit there and then trade medium or light to try to inch your way forward and you get blown out by a callus. Imagine doing 2 weeks of work to try to inch your way forward because you're so close to the bust point that a news event busts your account and you got to start all over. You waited 2 weeks to start all over and then you have to go 5 days to get your account, as opposed to 5 days, then wait, and then strike. Found out that you can get to your ultimate funded goal by my win rate like 4 times faster. It's faster and cheaper to cycle through multiple accounts than it is to sit at the starting point and slowly inch away and then ultimately have a catalyst blow you the wrong way. So again, mathematics is the key there. Statistics, you can't argue with that. Anybody that says anything to that is obviously not that gifted in understanding statistics. It's faster to rebuild an account in a 5-day period than it is to wait 3 weeks and get blown because you never built any buffer on the account. So the goal is that you have accounts that are ready to go. The day you have the perfect setup, today was the perfect setup. Today was such an easy trade to see. The perfect setup is where you, okay, this is buffer day. Okay, I got all the accounts slightly off of the static drawdown and now we're good. Now I've got real funded accounts to trade with. Now I'm going to trade my normal risk management rules day going forward on each one of them. And then each one of those you try to build your income off of. As soon as you get to your max payout without the split, then you close down the account and you take that money and fund your own trading account. And then that's the best way to fund yourself as a trader. Statistically, the quickest way to fund yourself as a trader. There's inarguably the correct answer. If you build enough buffers, Zach has said, yeah, with Apex on the PA, it stops trailing after you hit a profit threshold. And the funded accounts are the same way in ETF as well. The trailing will stop. The problem is the trailing drawdown takes longer to win because you have a tighter drawdown. Again, it's better to build a static account in 5 days than it is to slowly build a trailing account in 8 days or 9 days or however long it takes, because you have to trade slower. They give you more to trade with to bust you, but you're going to trade smaller on that because the drawdown is trailing, right? Oh no, I haven't stopped at the funded account. I just haven't. I was on vacation on my laptop. I just forgot to open it today. I'll keep doing it on Monday. Still doing the challenge, 10K challenge, still going. Oh yeah, Zach is 100% right. Name of the game is patience. You have a set of 20 evals on standby, which are passed, but you have 6 trade a day. You just have to trade 1 day to pass, which I can do if your PA fails. It's a whole set of 20 PA, right? See, Zach understands how you play the game. That's correctly how you play the game. The idea that I'm going to go get a funded account, I'm going to get funded, I'm going to go make money with it, and there's my dreams come true is not right. And I've talked to people like Zach is good. Karan, I don't know if he's still here. The way you utilize that to your advantage is the numbers game and understanding these mechanisms like Zach is saying. You have to know what you're supposed to do, and there's all these hidden things you need to do that you need. It's like a puzzle to figure out. So in the days you're not trading, like, okay, today's a weird day. What am I going to do on a day that the risk is high? I've got red lights. It's irrational. I'm going to sit out on my real accounts, but today's the day maybe I'm going to gamble and try to make another account funded. So let me do another eval today. What's the loss? It only cost me $75 to build that account. Okay, let me give it a shot today. I want to make a trade, but it's too risky for the real account. Let me trade the evals. So it's like at any point in time, your first decision that you're going to do is you're going to wake up and say, what am I trading today? My evals, my practice account, my second step, or my funded? Like, which account do I want to trade today? Each one of those have different goal. If it takes 5 days to get an eval, okay, so maybe the days you sit out when the risk is too high for the money accounts, just start building evals. You want to have a stack of those things sitting there. And then you don't want to go mirror your trades and put all 20 of them on the same trade. That's really stupid because you're eliminating the purpose of them allowing you to have multiples. It's not to multiply your gains. Your job in funded trading program is to make your money and get away from that. You don't want to be trading on 1099 income. Even if you make anything, the company takes 20% from you, the profit split. Uncle Sam takes the other 40. You walk away with dick at the end of the day. Your job is to make as much as you can before they take their profit split and then walk away and fund your own trading account at the 60-40 rule. Uncle Sam takes 20% less. They don't take a 20% profit split. You make 40% more of your profits by trading on your own. No way. So your job is to make 10 or 15K from this process as fast as possible after taxes, and then you start your own trading account. A real account. Your own money. You do not make a living trading from funded trading accounts. That is a bullshit lie. You wouldn't want to. If you were good at trading, you would be good enough to understand that you want to move on your own. So the idea is this is used as a backup way for you to scrape together money. So as a trader, let's start down. This is, again, I'm gonna call it after this. This is really what you need to use this for. Again, it's all math and statistics, the quickest way to get to your goal. You as a trader want to have money in an account. Like, let's just call this your account, You need money in this account. You either have ways to do that. Number one is you're either rich or you have a job that has money, or I don't know, borrow money or funding program, funding. This has the best tax rate. This gives you the best profit share. Your account. You need to fund your account somehow. This might not be a lot of people. Some people may not have extra money after their job. It's kind of silly to borrow money. Let's eliminate all these possibilities. You don't have any of those options. You need a funding program. Your funding program's goal is to fund your own account. It's not to raise capital. Funding programs have an additional benefit, and some of them say we pay, like they'll say like we pay you 100% of the first X dollars. This is your finish line, okay? This is a checkered flag. That's your finish line with that company. If you go beyond that, you're not optimizing your approach, because beyond that, the company, not only is it 1099, it's different than capital gains. It's not capital gains that you're getting. This is cap gains, taxed way differently if you're actually making money. The thing that you don't think about as a losing trader is how much Uncle Sam likes to split your trading account with you. You don't ever think about it until you start making money as a trader. And once you do, it's the first thing you think about. Your very first year as a trader that makes money, and you do your taxes and you go, huh, fuck. That's not really a lot left over after all. Then traders get smart and go, ooh, maybe I'm going to stop day trading options, start day trading futures, because that's a tax break. Or not tax break, but like better tax liability in my favor. Okay. All right, so I'm going to trade futures. That's better. And you go, ooh, I got to split profits. Like, you think about these things that once you start making money, taxes is a big part of your equation. Commissions, taxes, optimizing how much you don't give away to other people. Pay smaller commissions, get a better broker. Okay. Optimize, trade futures on your day trading account, save money on taxes. You don't want to lose like this like 80-20 split or 90-20 split, because not only this takes money from you and that takes money from you. Your big amount of gains get whittled away to a small amount of gains if it's a funding program. If that was equivalently your account, you're like up here. You get to keep a huger majority of that. Funding account is only should be used to seed a real trading account that you own. That's it. You don't want to live your entire trading career paying everybody for your hard work. So the idea is your job is to get to that finish line the quickest with as many opportunities as you can to maximize you funding your trading account. So if they give you 20 accounts, don't buy 20 accounts and link them. That's silly. You want to take if they give you 20 accounts and each one of them pays you your first 10K, you're going to end up paying a lot of money if they all reset. Treat them like build them one at a time. Get your first 10K, close it out. Get your second 10K, close it out. Third 10, keep building those 10Ks and then done. And then start a new one and then done and start a new one. And keep buffering yourself some cash to trade with. And if they say you can only do 20 and no more, then you max it out and you move on to the next company. There's an infinite number of these companies to go trade with. Just keep rolling your bankroll and moving from company to company. If you ever get to the point that you're splitting profits with them, you're an idiot. You don't need them anymore. You need them to give you the part of the little, this is our incentive to get you to come to our company instead of the other person. Okay, well, I'm going to go there and I'm going to go, you give me 3 months of your gym for free. Well, I'm going to go there for 3 months. And then on month 4, I'm going to find the other gym that gives me 3 months for free. And then at the other one, the other gym gives, and you can go to the gym for free because there's a million gyms out there. So again, your job as a trader is not to be a victim of the system. Your job as a trader is to find ways to beat the system. And these are ways to beat the system. The whole point is to be more clever than the next person out there. Milk it as much as you can. Milk and move on. Build your own account and then trade your own account seriously. And if your account blows up, you've got this whole process to reseed your account. So you want to get to the point that you have to split profit and then you're done. And if they let you open multiple accounts, do it again and do it again. And on the days that you have your funded account that's making money, you have your eval account that's not. If you're kind of like, okay, it's not really, I don't know if I'm going to risk losing the funded account. Okay, let me spend just a tiny amount of money and try to get another eval funded. Okay, today's a great trading day. Okay, I'm going to hit that funded account. Okay, I'm at the 8K goal. Good job. Ooh, risky trading day. You know what? Let me start a new eval. They give me 20. This eval is halfway there. It's very risky. You know what? Let me just YOLO a quick eval. Hit it really hard. Oh, it failed. Okay, that only cost me 75 bucks. Okay. Oh, it's a very solid trading day. Okay, let me move back to the funded account and this eval account. Oh, I finished that one. Cool. And this one hit the 10K. I also finished that one. Okay, that's good. That's good. Ooh, these days are highly volatile. And I say YOLO, not really YOLO, but like, let me go in and trade risky eval. There's very little loss to trying an eval to try to get it to the funded stage. Riskier days, you want to play the low crap tables, the low dollar crap tables. Build an eval, get it funded, don't trade the funded account. You fail the eval, you start over. It's a 5-day process to get it funded. The 2 that I did, I got funded 5 days later. Funded one, funded another. The funded accounts, I don't trade when it's risky. I wait. I wait for all the signals to line up. And you spend all day just building those funded accounts and take the money that yours. And that's it. You're not an idiot. I'm just trying to say things to get y'all thinking. Just think more about everything you do in this world, in trading. The people that constantly win, they just win because they outthought you. They know more about the market. They know more about how it works. You have to try to think, how can I, again, my brain is always like, how can I beat this system, right? What's the statistical way to optimize my approach? And I think Karan, I don't know if he's here or some of the folks that do this. Do you guys rotate through accounts kind of like that? Like some days you're like, okay, today's the day I'm going to build that eval to be funded. Let me just make that my trade day. Or today is a really nice, solid, low risk day. Let me trade the funded account, right? Do y'all do it like that? Zach says 1099's horrible, although you set up your account or your LLC. Hope to save some taxes that way. Good day, last 2 days. Gotta go. Later, Ben. See you next week. The funded trading accounts are good to learn from. Your own account, the way to go. Trader funding programs, in my opinion, are useful for 2 things. Number 1, temporary solution or a desperate solution. You hit rock bottom. You blew up all your money to get money. To get a bankroll so that you can re-enter the game on your own terms. You can start your own account. You go broke, you can go borrow money from your parents, you can go get a job to fund your own account, or you can go to one of these places to earn it back from scratch. The other real reason I like trader funding programs is because it's actually, you have paper trading, right? You have real trading. Paper trading, no risk, no reward, waste of time. No emotions. No growth as a trader. You just go nowhere. You waste your time. Real account, high risk, high reward. Best education, right? Highest emotions. But it's expensive. The downside is it's expensive. Your tuition for real emotions and real risk and reward, it's a very expensive process. So here's the cool thing about funded programs. Right? You pay a monthly fee. You get something if you win, you get a prize. That's risk and reward. You actually get some risk and some reward. It's like in the middle. No risk and reward, some risk and reward. I pay $100 a month and they're going to give me $10,000 profit if I make it to the finish line. I'm going to take this a little more seriously than that because I'm actually paying money for this experience. Are there emotions? Yeah, you're sweating it out. You're about to blow up your funded account. Your heart rate's going to go up. So emotions. And are the emotions the same as this? They're almost the same. You're going to treat it the same. If you're hoping to make money as a trader and you're right at the finish line of building a funded account and you don't have any money to your name, your heart rate is just like if you're some rich person trading away your money. You're going to get the same amount of excitement. You get the same amount of fear, the same amount of greed. You have so much hope built up into this middle system. You're going to treat it with emotions. So essentially, I call this no emotions. You're paying for emotions. Here you're renting emotions for a monthly fee. And you really can't beat that as a new trader. This is where you need to learn trading in this middle tier. Do y'all agree? You get real risk, real reward, real emotions. You're going to take it seriously. And now you're trading for real, quote unquote, with the real things traders need to practice for, like $100 a month. Not a bad loss to you that's not blowing up your family's inheritance to learn the same emotional control. To me, trader funding programs are the most invaluable addition to the world of retail trading for the newbie trader. You can also trade micros to learn, but you can still blow up your real money with no control. Not only can you rent emotions, but there's extreme tight rules. It's harder here, and here you have no guidance. Yeah, you can trade micros if you have control. But the whole goal is a new trader, you can still bust your account on micros. You have to, I can guarantee that you have the control. You're 100% right. I used to tell people just trade micros and have control. But now it's like, how do you know someone has control? You can still bust with micros. You nailed it, Badger. So the idea is in a trader funding program, no matter how shitty you are, how bad your control is, the worst you're going to lose is your $100. But you're going to feel all the real pressures and heat of a real trader, which I think is amazing. I think that is the best place for somebody to learn day one. Because you have a limited reward, you have a fixed risk and a fixed reward, basically. You get a funded account, that's your prize. You pay $100 a month to try to get it. You're actually renting those emotions for a very, very, very nominal monthly fee. And any human being, any person, even the guy that asks you for $1 on the side of the road can come up with $100 a month. Anybody can have $100 of expendable cash a month. I don't care how your lifestyle is or what your wages are. Any human can afford this opportunity. So there's no exclusionary things here like a PDT rule stopping you. Any human can enter this challenge world. Anybody can afford this. And that's what makes it the perfect place for training. All right. One more thing before we go. Can I look at Amazon? Sure. Let's go. Today was a great session, y'all. I love having these days. Y'all learn anything today? Job fun. Amazon BLD. Let's open it up. Liquidity map. Let's go. BLD. You have hedge pressure support and monthly hedge pressure support. Where is that down here? So yeah, I mean, Amazon, there's really no actionability to it. It gapped up. It's supporting here. If the rest of the stock market's likely to hold its half gap, Amazon's likely to sustain at least above its half gap too, as long as things are tracking. I really wouldn't see it as actionable. It doesn't look like it's going to fall. Clearly, it has supports way down here. However you feel like you want to trade that, it's up to you. Honestly, if I woke up and I was already long Amazon, I would certainly have puts here that would kick in case it does fill its gap. And I would hold puts for the day to cover a long position. Would I enter a long from here? Probably not. There's no actionable long point to get in. I would certainly utilize this information, the possibility of it to fall in a bull market, to make sure I have put protection on Amazon, though. Not investment advice, just what I would do. Like I said, I only like to long off of something to something. Stocks like this don't have any actionable point today. What people actually might do would be sell a credit spread off of this. Clearly, you can make a bet that resilience is positive. So Amazon's likely to stay off of its close, not to fill its gap and collapse. So the unlikely event is down here. So you'd want to sell your puts in the unlikely area. So those are likely not to strike in the money. Sell puts 0 DTE for today. And then you can buy puts right here just in case Amazon collapses down. Now you've got yourself a vertical debit spread, a little bit of price that if Amazon goes nowhere, now again, if you had long the position, you'd have insurance if it fell. You'd make money on the puts you sold. So in that debit spread, if it ends up in here, it's the max bang on your buck on those options. If it collapses, well, these will have higher delta than those. You're going to be making some money on that trade. So you're going to make the most money there, some money there. And you're going to lose money if it closes up in here because of debit spread. So I think those kind of trades are great in bull markets that are volatile. Market's not volatile enough for these to collapse, honestly. The idea is that I don't think the market's volatile for this to collapse. I'd want to be in the sell puts camp. And I'd probably short and sell puts in a way. So if I short and the market goes down there and stays inside of here, you've made money on both trades. If the market falls out of here, then just close out the puts. Your shorts could cover you there. So I like to look at trades like structuring that way, like shorting the shares and selling puts against it. That's always a great trade to bet on no volatility, right? VIX is collapsing. So it's a very high probable chance that stocks don't become volatile by the end of the day. So I don't know. I would say, if you're asking me what I would do, I like to bet on when markets are not volatile and VIX is collapsing. I like to be betting against the idea that markets will collapse instead of betting on direction of Amazon. I want to take a trade that if Amazon stayed flat, I'd still make money. Obviously, selling puts in that side would be a gain there. I would sell volatility. Collapsing, obviously, when you sell premium and VIX collapses, IV goes in your pocket, which is great. So the somehow legging into a sell side of a put would be how I would trade something that is clearly bullish, opening very high in bull territory, not actionable to take a direct long on. But Ashton likes to take the next side of the coin and engage in iron condors, which allows you to trade. A similar approach would cost the other side. 65% off on ETF. Ooh. Very nice. Do you have the code for that? Is there maximum days to qualify for an Apex account? Does your progress reset each month if you don't meet the goal? Can't find those answers anywhere. That's a great question. I'll have to look into that. All right, we'll see you guys. How do I consider VIX when getting into and out of options? In general, a couple things. If VIX is below triple B, then volatility is going to decay for the month. Okay. So number one, up until the third Friday of this month, VIX is in decay. So volatility is dead. It needs an event. Okay. Is there an event today? No, nothing in the news coming out today. So no event today. Volatility is going to collapse. Now let's just double check that. Is there any possible approach on VIX causing me any kind of resistance here? No. The volatility is in collapse, and the VIX can continue to collapse before it hits its first spot to create some boundary condition, right? So bull zone bottom on VIX is one of our irrational rules. We're far enough away from that. VIX will have to fall very far to get there. And so, nah, not really going to bet on volatility today. So today's an idea that I can see volatility is clearly safe. There's no mechanism for the market to spontaneously become volatile until maybe options expiration. So yeah, like I look at it like that. Check VIX futures, check the liquidity map on VIX, on EVXY. Zach says there's no max days. Take as many years as you'd like. Progress doesn't reset each month as it's carried forward. Oh, good to know. Quest said the same thing. Hey, so in Apex, when you get funded, do you have to like go through a process? Because I know I did it with ETFs. So like you have to like sign some form, they email you something like, congratulations, you got funded. How do they do that? And also once you pass, you get a PA account. You have the option to sign up using monthly one-time fee for 10 years. That's all Apex. Let me look it up. Apex. Affiliates, tools, testimonials. About. Oh, here it is on the main site. All right. What do they got here? Full, static. All right. So they got. Okay, so they have different plans. Rhythmic Ninja Trader, and they have Trade of 8 Ninja Trader. Okay. 100K static. They only have one static. The rest of them are full. When full looks like it's a profit goal with a trailing drawdown. So it's a trailing drawdown account. Max contracts. Okay, very similar to the trailing drawdown ETF and the stack ETF. So 100K static. Is there a minimum number of days? Doesn't look like there's a minimum number of days stated. Well, that's good. Is there a minimum number of days on the static? Like 5-day minimum, 10-day minimum? Doesn't say anything on here. Can you get that account in a day? In one trade? Apex 7? Where does it say that at? Is there like a... It's not... Yeah, you guys are right. This website does not say that on the surface. I got to dig for that info. Okay. 7 days for static. Because it says... There's no like click here for more information. Okay, so 7 days. That's still good. If it takes like a week or less, that's great. Oh, here it is. Hit your profit target before you hit your max drawdown within 7 days of trading and you qualify. It's at the top. It's just not in each one of the packages. Okay, so I got a minimum trading days, 7 days. The trading day counts as 6 p.m. to day p.m. Okay, so it's at the top. They should structure it a little better under each package. But I guess it's universal. Okay, that is cool. I'm glad they said that up there. No mistake. Okay, FAQs found it. Yeah. Yeah, that's it. You just go in and make a trade, get in, get out, and call it a day. Yeah, like I said, Zach is nailing it. You have to find all the tricks, the ways that you can cut corners as a trader. That's the easiest way to do it. Yep. So 7 days since the account started or 7 days and since your last reset? I'm curious how that works. So if you reset your account, does a 7-day timer start over? I presume it would. Yeah, that does make sense. So 7 days with Apex, and you can get like 20 accounts. So like ideally what you'd want to do is just listen for these deals, right? And when they get you these deals, all of them are doing crazy deals. Keep signing up for them and get those at really low rates and just try to stockpile some eval accounts. And then work through them one at a time. Currently you're 200 away from an Apex profit goal. Nice. Is Apex having a deal right now? Up to 20 accounts max. Okay. 80% off. 80% off? And you can buy 20 of them? That's not a terrible deal. It's also cheaper to get a new account than to reset a blow up. But see, you guys are coming up with all kind of cool tricks and tips, right? I agree. You're $36 away from 50K. Zach, baby, let's go. Yeah, don't pay any resets. Right. Yeah, don't, yeah, like be smart. Yeah, don't pay resets. You don't have to. It's cheaper to bounce to a new company than it is to pay a reset if you can bounce to a new company or even get a new account, same company. Yeah, never reset. Y'all are so smart. Don't we get all the smart people watching our stream? You smarty pantses. All right, I'm out. Love y'all. Great trading week. I think I've made wins every day that I traded. I would have made 3,000 something the day. I forgot. What was it? 33, 20, 74. Pretty decent profit day. Bull rally and bear squeeze all going on at the same time. Markets pushing higher. Monthly map showed this from the start of the day. Started to show this since the middle of October of last year and still going strong. DD 0.88. This bull rally is not stopping anytime soon. I like watching gurus out there. I've been shorting this thing since the beginning of the year. Being wrong. Hate to say it. I'm not really bragging, being right, but man, people just don't believe things because they're using weak tools. We use strong tools. I don't doubt what I see. Rock Scooter shows me everyone's homework. Shows me everybody's position. It shows me everyone's still long, getting longer. Why would I want to fade this? Sounds silly to go against the herd. Might as well just go with them. Trade what it is, not what I want to be. Have a good bias trout Rock Scooter today. Love to have you guys check out the platform. $35 a month for the full experience for 3 months. You cannot beat that price either. 87% off.